This is The Wealth Puzzle with Michael Mansfield from the Lynn Group. When a part of your financial strategy is out of tune, your long-term goals, your retirement savings, and your legacy can all suffer. With many years of experience in the financial industry, Michael provides his clients and prospects with the information they need regarding Social Security, retirement income planning, wealth management, and much more. Listen in as we address your financial concerns and provide helpful solutions to put you on the path to achieving your retirement goals. And now, here is The Wealth Puzzle with Michael Mansfield.
Howdy, everybody. Thanks for tuning in. I'm Mike Mansfield. It's good to be here making a video. I know it's been a couple weeks. Just been busy trying to digest so many things going on. Holy cow. We are busy in the economic front, the data front. We've got geopolitical things going on. We have a potential new Federal Reserve president. We haven't done a video on him just yet, just because we're waiting for him to get through all the hearings in Congress to make sure that he's the man and there's no drama there. But a lot going on, some volatility in the market, a lot of technology sector issues going on. So busy. But still, things are fascinating. And so I wanted to be the bearer of good and entertaining news. When we made kind of our year-to-date targets earlier in the year here with our videos, a couple of things we talked about. One of the things we touched on was earnings projections. Earnings projections for companies were very positive for this year. And if they're positive for this year, that doesn't necessarily force the market higher, but it creates an immense amount of stability in the valuation of stocks. And so far, so good. Earnings are coming out. They're doing incredible. In fact, let me pop this on here. So FactSet. So a couple things that we can see on here, blah, 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 blah. So far, I highlighted way too much stuff. So far, earnings for the fourth quarter that are almost wrapping up. Right now, we have about 75% of the S&P 500 has reported earnings. The average earnings growth is over 13% right now. So we had said coming into the year a few weeks ago, the target for this year was around 14%. So we're within grenade throwing distance of that, which is fantastic. It's really good, double-digit growth. Remember, a lot of this is to kind of break that feeling. The feeling is we have a lot of anxiety. And so there's a lot of anxiety around inflation, around wages, around labor, and all of this just fear of what's going on. But at the end of the day, the stock market is supposed to be a bunch of stocks, a bunch of companies, and did they make any money? And if they make money, then that supports the valuations. Unfortunately, the stock market in so many situations has turned into this short-term emotions gauge where we just get upset, the market goes up and goes down based on our emotions. But the reality is boom, right here. Earnings are rolling in, and reality is reality. They're making a lot of money. What's more entertaining, though, is you have earnings, but then you have revenue. So revenue is kind of what's the net benefit of all of those earnings. And right now, revenue is 9% for these companies off of these earnings, which is phenomenal. In fact, you can see here, if this is where revenue comes in, this will be the best quarter since 2022. So in a number of years, this will be phenomenal. So I'm really excited. Like, this is only going back to that base case. Deregulation, favorable Fed, great earnings, GDP going up. Like, these are all the things that make the stock market ultimately go up. Obviously, there's a lot of chaos. Obviously, there's a lot of headlines. There's a lot of overwhelming things. We suddenly have a bunch of geopolitical issues going on in the Middle East again. But once again, are those noise? Or are those things that are going to affect the bottom line of these companies? That's the great debate. We shall find out. Just a couple days ago, we got Consumer Price Index, so CPI. So this is the most broad measure of inflation. There's a lot of different measures of inflation, the PCE, Urban Index, is all kinds of stuff. But it came in at 0.2. So it came in a little lower than expected the other day. I think they're expecting 0.3. And what you do is you then times that bad boy by 12. And what that says is annualized inflation at the moment is at 2.4%, which is now just once again hitting kind of a low spot. And if you strip out housing, it's even lower than that. It's closer to 2%. So inflation has softened. Inflation is under control. This means prices are still going up. It doesn't mean it's going down. Even if inflation was zero, we've still locked in all of that inflation. You can kind of see on the left side of this chart, that big peak back in 2021, 2022, where you had inflation ultimately in 2022 hit 9%. All that is still locked in. That hasn't come out of the system, but at least the growth trajectory of the prices have gone down. And then we had a recent jobs report that said that wage growth was up year over year, I think at 3.7%. And so net, what that says is all of the sudden, people's wage increases are now outpacing at least current inflation. Once again, doesn't mean that that makes up for the 20-30% that prices went up a few years ago. We're all kind of dealing with that, but at least this is a positive indicator of probably what the Fed's going to be doing, the trajectory of a lot of different things. Now, what is the true driver of inflation? At the end of the day, it's the money supply. The more money that we put in the system, the more inflation that exists. The money supply is defined as this chart. It's called M2. I've touched on this many, many, many times over the years. And here you guys can see that I have this, 30 plus year chart on the screen. And the dotted line, the green dotted line and the blue line, which kind of run on top of each other since 1995 all the way to mysteriously 2020, money supply grew at a very controlled rate of 6%. Now remember, between 95 and 2019, the average inflation was like 1.7%. We treaded well below the 2% inflation risk. It was very controlled. Remember, we had massive inflation in the late 70s, early 80s, and then it got very under control. The money supply now grew at this very consistent tick, even though it's hard to see because I can't annotate on this thing. I don't know if you guys can see my cursor or not, but right in the middle of the screen is a little tiny speed bump right at 2008. So that's, remember when we had the worst financial crisis in 100 years and we're printing tariff or TARP money and putting it out in the billions? Well, it didn't really increase the money supply because even though the government created that money and gave it to banks, the banks never lent it out. And because the banks never lent it out, it never led to hyperinflation at that point. Fast forward to 2020 when COVID hit, and through 2021, 2022, the government massively increased. So as you can see on this chart here, there's this huge bubble where obviously our money supply went up, had a 40% increase in a very short period of time. That's what created all of the inflation. And since then, obviously it's come out. There's still a little bit of a gap to the line, but in the last 3 years, the money supply, even though it's coming down, it's only been growing at 3% a year instead of 6% a year. This is the true trend line of why inflation is just slowly softening out. If we can control the M2 money supply, then it's going to be hard to see inflation come back. And so those are some of the interesting things going on at the Federal Reserve right now. Right now, Jerome Powell is printing money, which technically will ultimately work its way into the money supply. So the risk is that inflationary. He's printed $90 billion since December, whereas the new Warsh guy, he doesn't want to print money. He just wants to lower interest rates and wait to print money till there's an actual problem. So he's actually trying to tighten up and control the money supply a little more, it sounds like, than Powell. Now, why is this relevant? Here is a money supply versus inflation. The blue line is the money supply. The red line is inflation. And so if you follow the blue line, it skyrockets first, and then the red line skyrockets right after it. Hence, the point being is when we flood the system with money, inflation follows. Now, it's also a trailing thing. So then when the blue line collapses, the red line finally starts to collapse, but it's kind of chasing it down. And so right now, like I said, inflation is really close to 2% because the money supply has dried up a lot of that excess money that's in the system at the moment. It doesn't matter. We don't have to talk about that. I don't have to talk about that. This is a fun one. This is government spending versus revenue. So this is obviously a huge issue in this world, as much as this, governs probably a stronger conversation around the health of the dollar, which I'll get in a second, is how are we spending? What are our deficits? How do these things look? And so if you guys can look to the right side of this chart where the gray bar is, that's, basically the COVID crash. And what you see here is revenue was down. Revenue came down to, basically the low $3 trillion range of revenue that time period. Yet spending skyrocketed, right? We're putting out PPP money and unemployment and stimulus, and we're throwing money everywhere we can to try to keep everybody alive because ultimately we turned off the economy. We told people to go home and not go to their jobs. So the government spent a boatload of money. Their spending peaked out in 2022, somewhere around, I think, $7.6 trillion. And it's come down since then, and it's, we'll say, kind of stabilized since then, but at least we haven't hit that peak since. Whereas if you look at the blue line, the revenue, what has happened since 2020? Revenue has skyrocketed, right? It's gone from the $3 trillion range to the $5.5 trillion range. And so in the worst of this, kind of around 2021, where the blue and the red line have the biggest disparity, you had about a $4 trillion deficit there, which is terrifying. And like the projection for this year at the moment is a $1.6 trillion deficit. So revenue is going up. Spending has at least stabilized over the last year or two. It's starting to roll over a little bit. This is a very interesting chart to watch. Will the government get this under control? Will the government generate more revenue? Will the government, through tariffs and things like that, have more money to help control the deficits? This is fascinating that these two lines are starting to tighten up. We haven't even had them cross, if you look at this, since basically the late 90s, right? Where the blue line was on top of the red line, where we actually had a surplus in our revenue versus our spending. So pretty wild times. Now, this is a funny conversation on this chart. So the dark blue line is the US dollar, but it's adjusted based on actual inflation. So yes, if you look at the far right, we can see that there was this peak on the dollar and then it's pulled back lately. So it's off of its peak. But if you look at where the dollar is from a historical standpoint, all the way back to the 70s, the dollar is still trading somewhere between 15 and 18% higher than its average. The dollar is not weak. The dollar is not collapsing. The dollar was really strong and now it's just strong. And so I think that we're giving too much energy and attention in the idea that, oh my gosh, the dollar is coming down, the dollar is collapsing. This is such an indicator that the end is near. That is just factually inaccurate. So kind of a fun chart there. The other fun one is this one. So this goes back to 1950, and this shows the S&P 500. Remember, we get into this game in our minds where we're like, oh my gosh, the stock market is so overvalued. Oh my gosh, the stock market, how can it support what's going on here? This is crazy and wild. The green dotted line is an 8% trend line. So the stock market grows, and in different time periods, it grows at 12% average and 10%. But the long-term trend line for the S&P 500 is 8%. And so if you follow the blue chart, you can see sometimes like here in the 50s and 60s, it was running above the 8% trend line. So the market was obviously on fire, possibly overvalued at that point. And then through the 70s into the 80s, it was going below the trend line as an average, and then it kind of caught up. And then we had the 90s run up in the stock market where it kind of skyrocketed and came back to the trend line. It's kind of funny. It just kind of hangs out at the trend line. And so, it crashed in, 08, and then it came back to the trend line not till about 2020. And so at the moment, it's just barely breathing above the trend line. Is that a good thing? Is that a bad thing? Doesn't mean much. I mean, honestly, look at these other time periods, from 1950 to 1970, for 20 years, it ran above the trend line before it came back. Even in the, early 90s to 2002, it was above the trend line. So just because we're barely above the trend line, this is not an indication in a long-term context adjusted for inflation that the stock market is suddenly so grossly overvalued. And this is an insane thought. I think that there's a lot of optimism here. I think that these are all positives. At the end of the day, markets are markets. As I mentioned a second ago, they're going to be emotional. They're going to be temperamental. They're going to do what they do best. I, once again, am optimistic that this is going to be a good year. It's going to end very positively for the general stock market. I think there's a lot of volatility. I think historically, when Federal Reserve presidents changed, so that's when Yellen came in, that's when Powell came in, stock market got a little pouty for a few months. So it would be hard to not be surprised by that. Other than that, one of the strategies that we're working on, we'll be putting out some content pretty quickly here on it, is we are so blessed and so lucky to have an incredible resource through Gradient Investments that they just got access to Brian Belsky, who is a gentleman you probably all see on CNBC pretty regularly. He's one of the most competent financial analysts that my whole career for 22 years, I've followed his research and always been shockingly impressed with the insight and accuracy that he has. And so he's come on board to help us build a small mid-cap portfolio. We've been putting that together. We think that there's a massive amount of opportunity moving forward for the next few years in the small mid-cap space. And so that's something that we're going to be rolling out pretty quickly here, and certainly giving access to everybody who's interested in that. So anyways, questions, thoughts, concerns, never hesitate to call the office. Obviously, reach out to us on our website, thelindgroup.com. Lind is Lynd. Otherwise, I hope everybody has a great day. Thanks for watching.